Yeah, over the last 4 or 5 weeks, we've seen tons of volatility, 50 basis point movements in the 10-year. I kind of think staying in cash and staying short duration, floating rate paper, stay short duration, kind of hunker down, because that's where the Fed's focused, and that's where, we can all expect to get paid back in short term. That 10-year moving up and down 50 basis points, that's a 3 percentage point move that occurred all within about 7 to 10 days earlier in April. So it's really hard to plan out when it comes to equities and credit, how those are going to react. We've had this huge snapback, 11% in the stock market in the last 30 days. Mm-hmm. So we're not out of the clear yet. We're not in the clear yet, so to speak, where, tariffs are still there. The rhetoric is still there. Unemployment is coming. Empty shelves are coming. You can see behind me, I have one full shelf and one empty shelf. Maybe that's a premonition that the empty shelves are coming. Batten down the hatches here and, to stay safe and stay short.
When you talk about having that, cash to the side, at what point do you deploy? How do you determine, okay, I got, I'm going to be generous here. Maybe I got 100K sitting to the side. When do I, set the metric, let's go to work?
I'll tell you exactly when that's going to happen and when you're going to see a windfall of cash leave the sidelines. It's when money markets go from a 4 handle to a 3 handle. And we're at about 4.25, 4.30 right now in money markets. We are one Fed cut away from investors not being satisfied earning even 3.99. That's this Mendoza line, so to speak, mm-hmm. of cash moving. But look at the shape of the interest rate curve as well when you do that, okay? You're getting about 4.30 on cash. You have to go out 11 to 12 years in duration, at least in treasuries, in order to get the same yield. Mm-hmm. That's why it makes sense to still stay short, is really the shape of the curve. And reminder, the Fed has cut 100 basis points in the last 8 months. Do you know what bonds have done in the last 8 months? Do you know what the total return is on bonds since they cut?
I'm going to guess that the return is, about a 5% just since the last cut?
Since September 17th, which is the day before they cut 50 basis points, the ag is down roughly 1.25%.
It's down, okay.
So since the Fed cut 100 basis points, bonds have actually lost money. And so we have some large investors that are coming to us kind of hat in hand saying, we don't really know what we're doing. The playbook that we thought was going to play out hasn't played out. What do we do? And so, right now, that's why you stay. And I'm not talking about staying in 1 month or a money market account. Mm-hmm. You can also go buy treasury floating rate paper. You can buy corporate floating rate paper. You can buy mortgage-backed floating rate paper. There's this, pretty large universe out there of floating rate bonds that are high quality that pick up 50, 100, 150 basis points versus sitting in a money market account and will actually benefit when the curve steepens out. Okay. Right. So you have an inverted curve, which is really bad for fixed income investors.
My answer to your question is I think betrays the fact that I am basically risk averse when it comes to investments. I take plenty of challenges and risks with my career and my life, but with investments, I've sought the stability of the risk-free investment in a lower producing U.S. Treasury. But I want to talk to you about what you've launched, because you just brought up mortgage-backed securities. And those of us who lived through the great financial correction, crisis, collapse, whatever you want to call it, will recall that mortgage-backed securities created a whole lot of hurt for a whole lot of people.
Yep.
So here, I think I actually created a kind of fun banner about the resurrection of mortgage-backed securities. They've never really left. I mean, they're part of they're necessary because you need liquidity to fund future mortgages. But let me ask you this. You've created an ETF. It's just recently, the MBSX, if people want to go look at the ticker for this. Describe to me what this ETF allows someone like me to do, because as I understand it, access once reserved only for large banks. I now have access to, and I don't understand the product, through a floating rate that I can now capitalize through the ETF. How does that work?
Right. So as an investor, you can go on to Fidelity or Schwab, click on trade, click on fixed income. You can buy a corporate bond. You can buy a municipal bond. You can buy a treasury. You can buy a CD. There is no option to buy a mortgage bond. Okay. U.S. residential real estate is one of the biggest markets in the world. It's $50 trillion. Mortgages backing those that real estate stand at about $14 trillion. So that's right. The U.S. residential real estate market, the LTV is only 28%. 72% equity is owned by U.S. homeowners. Okay. But this mortgage-backed securities market is gigantic. It's $12 trillion. It's the second biggest fixed income market in the world next to U.S. treasuries. Okay. But when you look at all of the 40X funds, ETFs, and mutual funds that can access or that are solely focused on mortgage backs, it's only about 100 billion. So you're talking about less than 1% penetration of 40X funds for individuals, but as well as, our main investors are independent RIAs that are managing money on the behalf of individuals. So, what Regan's doing, and this is our sandbox, all we really focus on is mortgage bonds. It's all I've done for 24 years. So what we're doing is we feel like we're democratizing access. We have a floating rate fund and a fixed rate fund that allow us and allow investors to access whether they want floaters or fixed.
Here's my question about mortgage-backed securities. When I hear MBS, when I hear residential mortgage-backed securities, whatever the MBS is, I think of what happened in the lead up to 2008. And I worry, I understand that there are regulations in place to protect investors, but how do you attract investors? And I realize you are dealing with very large individuals who are taking advantage in a good way with the ETF. But how do you attract investors who might have gotten burned the last time around?
Yeah, so let's take the years 2007 through 2009, 07, 08, 09. I was in New York. I was working at Cantor Fitzgerald, trading, large swaths of mortgage bonds. And what blew up were non-agency mortgage bonds. Countrywide, Residential Funding Corporation, all these companies that went bankrupt, right? Because they were taking on so much leverage, and institutions like AIG were using 50x leverage to buy these. But when you look at the agency market, and we're talking about Fannie Mae, Freddie Mac, and Ginnie Mae, they did 7% annualized returns. The mortgage-backed securities index between 07 and 09 returned 7% annualized. Okay. So in these products, we're only focusing on agency paper, government guaranteed. Lest we forget, Fannie and Freddie are currently in conservatorship, and Ginnie Mae has been a government-owned entity since 1968. So we're only focusing on agency paper. Agency, I don't want to say it's the same as U.S. Treasuries, but it's the same credit in terms of these are U.S. government sponsored or owned enterprises.
Yeah, the applied backup, yeah.
Exactly. We do run into folks. I had a call today with Europe, a bunch of European investors, and they're like, hey, this is a bad topic, even though it was 17, 18 years ago. And you show them that chart and you're like, hey, look, let's look at what agencies did. And they're like, oh, I didn't realize that. Just like, when I ask people, what do you think bonds have done since the Fed started their cutting cycle? Oh, bonds are yielding 5%. They probably made 5%. No, they actually lost money over the last 8 months. So it's really it's a lot of education. But if you take the bond index is roughly 1/3 mortgage backs. Read Barron's this weekend. Rick Reeder, his number one idea is agency mortgage backs. PIMCO, their number one idea is agency mortgage backs. So what we're doing is we're creating little silos to invest in that you can pick and choose. Oh, I want floating or I want fixed. Instead of just saying, all right, I'm going to give a $2 trillion manager money and hopefully they're going to be nimble enough to move around into the best possible product.